All right, let's get right into this explainer and put on our expert investment analyst hats. Today, we're unpacking a really fascinating tech distributor called ScanSource. We're trying to answer one massive question here. Is this actually a good stock to buy if we look at it through the eyes of the investing legends? We're going to run this company through the absolute gauntlet, applying the classic frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then we're going to back it all up with some hardcore discounted cash flow modeling. Let's do this. Here is our roadmap, company snapshot, the Buffett lens, the Lynch lens, the Graham lens, DCF, and other models, and synthesis, and final recommendation. Section 1, company snapshot, ScanSource. So let's establish our subject. We're looking at ScanSource, ticker symbol SCSC. Now, this is an electronics and computer distribution company with a market cap sitting right around $1.08 billion. But here's the thing, they aren't just moving boxes anymore. They are uniquely positioned in complex tech, like cloud, connectivity, and SaaS, and they are aggressively pivoting toward high-margin recurring revenue. Now, before we start crunching the hard numbers, let's make sure we're on the same page about a crucial metric that's going to be the absolute star of today's analysis: free cash flow. You know the drill. It's the net cash provided by operating activities minus capital expenditures. For ScanSource's management team, and honestly for us as analysts, this is the ultimate indicator of the company's true liquidity and its raw cash generating power. And this pivot we mentioned, it is completely central to their new business model. ScanSource is shifting heavily toward a working capital light agency model. And in this specific model, they already boast an astounding 98% recurring revenue gross profit margin. I mean, wow. This structural pivot is exactly what makes them such a compelling case study for us today.
Part 2, the Warren Buffett lens, moats, and management. All right, let's view SCSC through Warren Buffett's qualitative framework. We know Buffett loves a strong economic moat, shareholder-friendly management, consistent earnings, and manageable debt.
So, checking off Buffett's criteria, ScanSource actually looks incredible. And why does this matter for your portfolio? Because strong fundamentals protect your downside, right? Their economic moat is actively growing, highlighted by their newly expanded HPE Juniper networking partnership. The management team is highly shareholder-friendly. They've already executed $71.4 million in share repurchases year to date. They're rocking a really impressive 14.3% adjusted return on invested capital, and their debt, it's literally negative net debt. They have $120.3 million in cash just sitting there, which completely outweighs their $102 million in total debt. Which brings us to a crucial point. Buffett absolutely loves what he calls owner earnings. And let me tell you, ScanSource is a cash machine. With $118.6 million in year-to-date free cash flow over just 9 months, SCSC generates massive owner earnings. When you project that out, the high free cash flow yield would very likely trigger a buy for the Oracle of Omaha, assuming a standard 20% margin of safety at current market valuations.
Section 3, the Peter Lynch lens. Growth at a reasonable price. Let's switch gears and see how this company holds up from Peter Lynch's perspective, focusing on company categories, the PEG ratio, and balance sheet strength.
Under Lynch's famous categories, ScanSource sits pretty squarely as a stalwart, but with some serious elements of a turnaround story because of that recurring revenue pivot we talked about earlier. Now, if we assume a standard moderate tech distribution earnings growth rate against its current price-to-earnings ratio of roughly 14, the PEG ratio sits around an estimated 1.5 to 2.0. So, okay, it's not exactly screaming deep value on growth alone, but Lynch would absolutely love their flawless balance sheet. Ultimately, Lynch would likely rate this one a solid hold or maybe a cautious buy. Part 4, the Benjamin Graham lens, deep value and intrinsic margin. Time to deploy Benjamin Graham's defensive checklist to interrogate the stock from a strictly quantitative, deep value angle. We're stripping away all the narrative here and just looking at the raw financial fortress. Going point by point, ScanSource passes Graham's defensive checklist with flying colors. Adequate size? Pass, with a $1.08 billion market cap. Strong financial condition? Pass easily with that net cash position. Earnings are stable with a positive Q3 GAAP EPS of 78 cents, and it trades at a very moderate PE of roughly 14 and a price-to-book of around 1.19. I mean, this is a textbook defensive stock. Graham also gave us his famous intrinsic value formula, taking the square root of 22.5 times earnings per share times book value per share. So let's walk through the math. When we plug in their annualized $3.12 EPS and their $37.76 book value, Graham's formula outputs a target intrinsic price of exactly $51.48 per share. Section 5, DCF valuation and other models. Okay, let's dive into the core quantitative models, starting with a discounted cash flow, or DCF, valuation, the absolute gold standard for institutional analysts.
To build our DCF, we have to make some grounded assumptions based on their recent 8K filings. They generated $118.6 million in free cash flow over 9 months, so we'll conservatively assume an annualized $150 million free cash flow base. Then we'll use a standard 9% weighted average cost of capital, or WACC, and a 2% perpetual terminal growth rate to run our mechanics. Running those numbers, our base case DCF yields a fair value near $58.50 per share. But it's really critical to note how slight changes in our WACC, or our growth assumptions, shift the valuation overall. For instance, even if we stress test it in a more conservative scenario with a 10% discount rate, the value still holds incredibly strong near $51. To balance our view, let's look at a couple of other models. The Simply Wall Street Community Consensus pegs fair value slightly lower at $46.44. However, if we look at comparable multiples, ScanSource has a trailing 12-month adjusted EBITDA of $144 million. Against their enterprise value, that gives us an EV/EBITDA multiple of roughly 7.3x. For a business throwing off this much cash, that is incredibly attractive. Section 6, Synthesis and Final Recommendation. Let's aggregate all these fair value outputs, blend our guru insights together, and figure out the final verdict. What is all this data actually telling us to do? Synthesizing the data, we start to see a really clear pattern emerge. The Benjamin Graham formula and our DCF models trigger strong buys right in the $50 to $60 range. Meanwhile, the Peter Lynch lens and community alternate models suggest a solid hold near the mid-40s. Now, we all know no investment is without risk. The overarching strengths here, massive cash generation, a flawless balance sheet, and that expanded HPE Juniper partnership must be carefully weighed against the realities of their business. Namely, they operate in a historically low-margin tech distribution sector, and they do face some significant vendor concentration risks. So blending all of these insights, here is the analyst verdict. ScanSource is a fundamentally sound buy at or below $45 per share. At that specific level, literally every single guru framework we just applied finds a margin of safety. Conversely, it becomes a hold as the price approaches the low 50s, which is right where it meets Graham's intrinsic value and our DCF base case. Which leaves us with a final thought to ponder as we wrap up. As ScanSource continues building out this agency model, which, remember, boasts nearly 100% recurring revenue gross profit margins, has the broader market fundamentally mispriced this cash machine? Definitely keep a close eye on those free cash flow numbers in their next quarter. Thanks for joining me on this explainer, and keep learning.